hedge funds and any other mutual fund had exchange traded funds, so they've beaten every hedge fund and every fund manager. So I'll teach you how they did this. And a quote that he has is investing in yourself is the best thing you can do. Anything that improves your own talents, nobody can tax it or take it away from you. They can run up huge deficits and the dollar can become worth far less. You can have all kinds of things happen, but if you got talent yourself and you've minimized your talent, you've got a tremendous asset that can return tenfold. So that's very important. He's referring to the skills that you acquire through the biotechnology program, business, mathematics, music, arts, engineering, skilled trades, healthcare, any industry training that you have. It's a very important mental model to use to be effective investors. So if you combine all those mental models together, you can do very well. So a very effective investment company could comprise of somebody, let's say, in healthcare, somebody with a lot of knowledge of healthcare, somebody with a lot of knowledge of pharmaceuticals, somebody with a lot of knowledge of education, transportation, skilled trades. Like if you combine all those mental models together, you can create a great competitive advantage into finding the best investments. So as far as I am concerned, the stock market doesn't exist. It is there only as a reference to see if anybody is offering to do anything foolish. So what he's referring to there is investments are long term. So it's best in his method, it's best to hold something for the long term and not sell based on panic. So you shouldn't worry about the day-to-day price of the stock based on his method. You should focus about how the company's operations are doing, how their cash flows are, how the return on equity is, how their competitive advantage is. If they're in an industry with the lack of competition, those are the things you should worry about. You shouldn't worry about if the stock's going up or down at any day. So these are some very important parts of his method. Are all we want is to be businesses that we understand, run by people whom we like, and priced attractively relative to their future prospects. I buy businesses, not stocks. Businesses I would be willing to own forever. Invest within your circle of competence. It's not how big the circle is that counts. It's how well you define the parameters. When management with an excellent reputation meets a business with a poor reputation, it is usually the business's reputation that remains intact. So these are very important pillars of a strategy. It's so reputation of the business is very important. Integrity, if you can trust the company, that's very important. And your your subject matter expertise. For example, all of you are very good in the sciences and biotechnology. That is a great asset if you're looking at companies like Pfizer and Moderna and AstraZeneca and companies in biotechnology. You can analyze them better than me because I'm very like I'm very my competitive advantages in business and economics and math. So you would have a better view of a company like a Pfizer. So that's very important. So you could specialize as an investor in biotechnology. So seeing stocks as businesses is key. So analyzing the business and not looking at it as stock, that's very important. Just view it as a company that makes money and figure out if it's going to keep making money. So, and also businesses you understand that's key to invest in because you want to invest in businesses you understand. So, for me, I understand companies in the technology and railroad banking side. So, and I'm better in those areas, but if you understand a different area, that's a good place to invest. So I'll get you to read this passage and tell me what you tell me what you think about this passage. So read this passage and what are they referring to? So I'll give you a few minutes to look over this passage here. Yes, so that's a big part of it, Abigail. Excellent. Yeah, so using a clear mindset to invest is key. So not bringing in emotion, that's very important. So I recommend to do that here, and don't panic. That's key. So if a stock price is going down, don't panic. Only sell when you know the company's in trouble. So if you know the company is in trouble where the management is a fraud, let's say they're losing cash flow, let's say no one wants their product or service anymore, those types of things, then sell. But if none of those things are happening and the price is going down, don't sell. So yeah, using a clear mindset, like Abigail said, is correct. That's great. So don't panic, have a clear mindset. So good news, the market is dropping. Practice a selective contrarian investment strategy. This one is in which the investor is motivated to invest by a falling stock price. Contrarians invest in what the market finds unattractive. Recognize that the majority of investors play the short-term investment game. So people sell when they panic. It's best to hold it when you panic. People sell bad news. So my question, so ask the question, if there's bad news, will it affect the operations of the company? If yes, sell. If no, don't sell. So just ask the question if it's going to hurt the company. Will it hurt the company's cash flow? Will it hurt the company's return equity? If it will, then sell. But if it won't, then keep it. Companies that have a franchise product and thus competitive advantage have the economic power to weather most bad news storms. So make sure that they have a franchise product or a competitive advantage. That's very important to a company doing very well. Competitive advantage is very key. Always invest in companies with a long-term durable competitive advantage, which we call franchise product. Product characterized by few or no substitutes, product in demand by many, little or no government regulation. So market volatility is your best friend. That's very key. So you want to buy when it's low here. But I recommend if it's a great company, if you believe it's a great company, buying at any point is fine, in my opinion. So if you think it's a great company, like a Microsoft, let's say, or Alphabet slash Google, I would recommend like any price point is fine because it's going to do well. It's going to keep increasing. So if they're a great company, buying low is ideal because you'll make the most profit, but you can buy at any point in time. As long as it's a great company based on this analysis, you can buy at any point in time. So So Buffett's 4 steps to investing and how stocks will make you wealthy. Turn off the stock market. Remember that the stock market is manic depressive, wildly excited sometimes, or unreasonably depressed. This behavior creates opportunities, but you do not allow the market to dictate your actions. Don't worry about the economy. Buy a business that has the opportunity to profit in any economy. Buy a business, not a stock. Change your perspective to that of a business owner and learn as much as possible about that business and industry. Manage a portfolio of businesses. So make sure that I recommend diversify across industries and countries. So one investment that I recommend a lot is the S&P 500 exchange traded fund by Vanguard or an iShares because it diversifies across global. So it has 500 different companies that have operations across the world. So they're globally run companies with operations across every country globally, and they have many different industries. So you diversify across industries and countries, and also the S&P 500 is is the closest thing to Warren Buffett. So Warren Buffett's beaten the S&P 500 over his period of investing, but the S&P 500 has come second over the last 50, 60 years. So you'll be second to Warren Buffett in your returns if you invest in an S&P 500 exchange traded fund. So I recommend that because it provides instant diversification. And I recommend the Vanguard and iShares ones because the fees are the lowest compared to the other options. So yeah, I recommend that. That is a great way to diversify. So investing is key because inflation is something that always happens. Your money's going to be worth less because of inflation. So every year we'll have inflation, prices go up. So that means our money's worth less. But if we invest, we can we can reduce the impact of inflation on our money. So so investing, we want to make a return that's greater than inflation to keep our money worth more. That's very key. So investing in, let's say, an S&P 500 exchange traded fund will be able to protect our money from inflation. Or using the Warren Buffett strategy, we can protect our money versus inflation. So as you can see in this chart here, the S&P 500, it's 13.8% here, lost 10, and if we go back here, lost 20, 14.6%, lost 30, 10.7%, lost 40, 10.8%, lost 50, 11.9%. So that's yearly. That's the average return per year. And if you compare that with CPI, the CPI is the inflation rate. It's a lot higher. So if you invest in the S&P 500, you'll do very well compared to inflation. So your money's going to be protected against inflation. So that's the return per year for the S&P 500. And over the last 50 years, only Warren Buffett has had a higher return per year than the S&P 500. No one else has a higher return except for Warren Buffett's Berkshire Hathaway. Yeah. So so the S&P 500 is second to Warren Buffett's Berkshire Hathaway over the last 50 years. So bond example, what happens when interest rates change? So with bonds, when interest rates go down, the bond price goes up. So if interest rates go down, bond prices go up. So that's just the case with bonds. So you could make money in bonds by having lower interest rates. So they have a negative relationship. So interest rates and bond prices have a negative correlation. So yeah, that's just so you can make money on the bond market by doing this. So bonds is lending to a company. So if you buy a bond, you lend to a company. So you can use all the strategies in this PowerPoint to find a company that you want to buy a bond for. And if interest rates go down, you'll make money on the bond. So that's another way to invest. So if interest rates go down, the bond price will go up. So you could buy a bond for a very good company based on the strategies here, and that would be a good investment. So we'll go through financial statements here. So income statement, this is how an income statement looks here. And here if we look at an income statement, we want the net income to rise. So we want our net income to rise to be a good investment. So as you can see here, it's going down. That's not a good sign. So we want our net income to rise. That's very key for us as an investor. So when we're looking at the income statement, we want our net income to rise here over time. For the balance sheet, if we look at this balance sheet here, we want cash and cash equivalents to rise over the years. So we want the cash and cash equivalents to go up. That's very key. That shows that they have more cash on hand. That means that they have more cash, which is good. We want so accounts receivable are a risk because if we have more accounts receivable here, we may not be able to collect it. So accounts receivable, we still have to collect. It's money that's owed to us by our customers. Our customers haven't paid yet, so we have to collect it. So we may not ever actually collect it because they may not pay it back. So that is a risk in itself. So that here it's risen, so we have more risk. We may not recover that. Also, inventories. If inventories rise, that means that if we don't sell those inventories, we can't make any money on it. So that's another risk here. If we have too much in inventory and we can't sell it, then that's a risk in itself. And then if we look at also goodwill is another issue. So goodwill is brand equity. So it's the value of our brand. So for Apple, their brand over this period has went up by about 4 times. So that's not a hard asset. It's just it's a predicted asset. So you can't sell like that 4.6 billion right here. So it's in millions. This would be 4.6 billion. That you can't sell that. It's just intangible. It's not physical. So it's a risk in itself here. We can't turn that into cash. That becomes a problem. And then we want to look at accounts payable. If we have more accounts payable, like we see here, that means we have more debt here. More accrued expenses, more deferred revenue, more commercial paper, more debt. As you can see, current liabilities, that's debt. It's went up by about 50% over this period. So that's not good. However, if we have enough cash flow that's coming in, we can pay that off. Long-term debt, as you can see, it's went up a lot over this period. That's a big concern. But if we have enough cash flow coming in, we can pay for all that. And then total liabilities, that's total debt. As you can see, it's went up by from 57 billion to 120 billion. So that's a risk in itself. But like I said, if we have enough cash flow coming in, we can pay that off. So those are risks that come up with companies. We want total stockholders' equity to be increasing. As you can see, it's reduced. That's a concern. Total stockholders' equity is assets minus liabilities. So we want it to be going up. But here, that's a concern. It's going down. So that means that we're having more liabilities than assets growth here. So we want assets to grow at a faster rate than liabilities. Here it isn't. So that's a big concern. So there are other things we can look at. So the current ratio here, we want the current ratio to keep going up. So the current ratio is the amount of current assets per current liability. So it's our ability to pay off short-term debts. As you can see here, it's went down. So that's a concern. Quick ratio also measures that as well. Cash ratio also measures that as well. As you can see, it's went down across the board. That's not good. That's not good at all. These measurements all show really the same thing here. It's all went down, so that's a concern. But we can manage this if we're making a lot of cash flow. We can pay off our short-term debts, so it might not be a concern if we're making a lot of cash flow. But if the cash flow stops, these become a big problem. So we can look at all this here, and then down here, the total debt ratio. We want the total debt ratio to go down. As you can see, it's went up. That's not good. Debt to equity, we want it to go down and went up. That's not good. So we might be taking on too much debt, but like I said, if there's enough cash flow, we can pay it off. Gross profit margin, it's it's been pretty steady, which is good. It hasn't changed that much. Net profit margin, it's still over 20%, which is good. Return on assets is pretty steady. Return on equity, as you can see, the return on equity is over 30% each year. So that's really good. So return on equity is one of the most important stats. As you can see here, it's over 30%, which is good. We want it to be at least 20% to give us a good margin of safety. So we want to look at these stats here. As we can see, return on equity is very high, which is really important. That's most important. Because it's very high, we can take on more debt. If it's this high, we can take on more debt. So that's why Apple's taking on more debt, because the return on equity is very high. They can pay off the debt. So these are some reports you can look at: the 10K annual report, 10Q quarterly report, 8Q current report filing. Those reports you can look at for companies to check all these stats. So a lot of this is available on Yahoo Finance. So you can look up companies in Yahoo Finance and check all these stats for these companies. So chapter 4, principles and rules of value investing. Investment philosophy of Warren Buffett. The basic ideas of investing are: 1, to look at stocks as businesses; 2, use market fluctuations to your advantage and seek a margin of safety. That's what Benjamin Graham taught us. 100 years from now, they would still be the cornerstones of investing. So there are really good questions to ask here. So business tenants, is the business simple and easy to understand? That's something to ask. Does the business have a consistent operating history? Does business have favorable long-term prospects? Is management rational? Is management candid with shareholders? Does management resist the institutional imperative? Focus on return on equity, not earnings per share. Calculate shareholders' intrinsic value. Look for companies with high profit margins. Make sure the value added is greater than 1. What is intrinsic value of the business? Can the business be purchased at a discount to its market value? So those are the things that you got to look at for companies. So I recommend asking all these questions when you're looking at investment. Is the business simple and understandable? Does the business have a consistent operating history? Does the business have favorable long-term prospects? Is the business simple and understandable? Does the company have an identifiable, durable competitive advantage? Does business have an identifiable consumer monopoly or franchise product? What is chance the product will become obsolete in the next 20 years? So those are good questions to ask. Is the business simple and understandable? What does this mean? Does the business make a product that's simple or complex for the average investor to understand? An example would be See's Candy. Everyone can relate to See's Candy, especially on special occasions. It doesn't take a lot of new technology to continue to make the product, and is relatively insulated from increasing prices. Compare this to an Intel, whose products may lead the market, but it doesn't have a lot of but it does take a lot of reinvestment of capital to maintain a competitive edge. So a candy company like See's Candy, it doesn't have to really worry about reinventing their product, because candy's candy. While in Intel, chips are reinvented every day. Technology is reinvented every day. Technology changes every day. So you have to reinvest capital constantly to keep up with for an Intel. But a See's Candy doesn't really have to. That's why Warren Buffett is a big fan of Coca-Cola as a stock, because Coca-Cola, you don't have to really reinvent Coca-Cola. It's soda. It doesn't really change that much. But a technology company, he doesn't like technology companies that much, because you have to reinvest constantly. So as you can see here, if you look at the growth rates of all these stats here, cash flow per share, earnings per share, book value per share, like all these things, does the business have a consistent operating history? So I'll ask the class, based on the stats here, does the company have a consistent operating history? So look at these growth rates here, and does it have a consistent operating history? So, so, um, so Abigail, what's your rationale for that? For that could be a good argument of, based on what stats? Oh, sales growth at the bottom. Okay, that's a good point. As you can see, the so yeah, you're right. The sales growth slows down. That's a good point there. The sales growth does slow down, so that's a good find there. So that's a concern that they're not growing that much. So that's definitely a risk to this company. So yeah, good point, Abigail. And then their value added has reduced as well, which is a concern. And their annual cash flow growth rate has reduced over this period, which is a concern. Honors, yeah, so their growth rate of cash flow is a concern. However, if we look at their shareholders' equity, it's increased by 32% on average per year. Their net profit has increased on average from 40 by 47.3% per year. And then the cash flow per share has grown by 51.3% on average per year. A return on equity is average 30.73% per year, but it's high, but Abigail was right. It's been slowing down in recent years on this chart. So that's a concern. So it seems like these growth rates are high because the growth was very high from 2009, 2010, 2010 to 2011. While from 2012, 2013, 2013, 2014, it's slowed down. So that's a concern. So an investor needs to do very few things right as long as they avoid big mistakes. We like stocks that generate high returns on invested capital with a strong likelihood it will continue to do so. I look at long-term competitive advantage and whether it's something that's enduring. So is management rational? Is management candid with shareholders? Does management resist institutional imperatives? So those are very important things. So you want to make sure that the management has integrity. You want to make sure you can trust them. So a company can have every good number in the book, but if you can't trust the management, that becomes a problem. For example, Enron had all every good number, but the problem was you couldn't trust the management. So the management had a lot of issues where they were committing a fraud. They Yeah, so you want to make sure that the company, you can trust the company and they're not committing a fraud. That's the most important thing because if they are and all the numbers are good, the numbers are going to be fake. So you want to make sure that you can trust the company, and it's very hard to determine if a company is trustworthy. Like some companies may seem trustworthy, but they're not. So I recommend diversification. So if you diversify across industry and country, own investments across industries and countries, if one investment turns out to be untrustworthy, you have many others and you'll be protected. So diversification across industry, country, that's very important. So owning investments across industry and country, that will be very key. So Warren Buffett way, when you have able managers of high character running businesses about which they are passionate, you can have a dozen or more reporting to you and still have time for an afternoon nap. So in evaluating people, you look for three qualities: integrity, intelligence, energy. So it's very important to have integrity. So it doesn't matter how much intelligence you have, it doesn't matter how much energy you have. If you have no integrity, nothing else matters. So if a company has the best intelligence and energy and they have no integrity, then they're going to commit a fraud. That's a big problem. So you want to make sure integrity is the most important thing because without integrity, nothing else matters. Yeah. So without integrity, the problem is they make up accounting statements, they make up numbers, they fake stuff, so that becomes a problem and it becomes a fraud. So the institutional imperative, this is defined as the lemming-like tendency of corporate management to imitate the behavior of other managers, no matter how silly or irrational that behavior may be. The institutional imperative is responsible for several serious conditions. The organization resists any change in its current direction. Just as work expands to fill available time, corporate projects or acquisitions will materialize to soak up variable funds. Any business craving of the leader, however foolish, will quickly be supported by a detailed rate of return and strategic studies prepared by its troops. The behavior of peer companies, whether they're expanding, acquiring, setting executive compensation, or whatever, will be mindlessly imitated. So, for example, one example of this is BlackBerry. BlackBerry back when the iPhone was created, they wanted to imitate the iPhone. Like initially, they resisted the change the iPhone had. Initially, they stayed with their keypad, and then what happened was they just imitated the iPhone, and that became a problem because they couldn't imitate it. They tried, but they couldn't do it well. So they tried to stay competitive with the iPhone, but didn't work. So they needed to go a different direction if they wanted to succeed. They had to go a different direction, create something completely different from the iPhone, maybe go into a different industry. But they just tried to imitate after they had so much pressure. So imitation is not a good thing. So things to look at for a company, the Warren Buffett way, financial tenants, what is the return on equity? What are the company's owner cash flows? What are the profit margins? Has the company created at least $1 market value for every dollar retained value added? Does the company have less than 30% debt? So you look at these accounting statements and answer those questions. And you want to have return on equity of at least 20% or higher. You want cash flow growth of at least 10% per year. You want return on equity, return on equity, like I said, over 20%. You want debt to equity to be less than 50%. Debt to equity should be less than 50%. So you want return on equity to be higher. Like higher the better for return on equity. Cash flow growth should be high. Debt to equity should be low. So you want debt to be low. You want return on equity to be high. You want cash flow to be high. So those are the types of things that are important. So what is the business value of the company? That is intrinsic value. Can the shares be purchased at a significant discount, roughly to 50% to its current trading price? This is a question to ask. So Buffett's 4 principles of investing. The company must have capable and vigilant leaders. The company must have long-term prospects. Is the stock stable and understandable? Company must be undervalued so you can make a good buy. So low debt, a debt to equity of less than or equal to 0.5, and a debt to total assets less than or equal to 0.3. High current ratio greater than 1.5. Strong and consistent ROE, return on equity. Buffett requires 8% average over a 10-year period. Cole likes to see an average of 15%. I say 20% just to give more of a margin of safety and appropriate management incentives. So you want to make sure that management owns stock in the company. That's very key because that means that they believe in the company. They believe the company's going to grow. If they own stock in the company, that means that they believe the company's going to grow. If they don't own stock in the company, they probably don't believe the company's going to grow. So if the company grows, they're going to benefit financially if they have stock in the company. So you want to look at insider ownership on Yahoo Finance. If you go to Yahoo Finance, you can check the insider ownership and see if they own stock in the company. So we analyze this. The current ratio has been going down, which is not good. That means they might not be able to pay short-term debts. Debt to equity has been going up. That's a concern. That means they have more debt. And then return on equity here, it's very high. So that's a good thing. So return on equity is very high. That's a really good thing. So that's probably why they can take on so much debt. When you have able managers with high character running businesses about which they're passionate, you can have a dozen or more reporting to you instead of a time for an afternoon nap. So integrity is very important. Integrity is the most important. And make sure they have integrity, intelligence, and energy. Integrity is most important. In the long run, of course, trouble awaits management that paper over accounting problems with accounting maneuvers. So the kind of business to invest in is one which is durable, franchise product, meaning that the business must be able to keep its competitive advantage well into the future without having to expend great sums of capital to maintain it. A low-cost competitive advantage is important for 2 reasons. First, the predictability of the future earning power. Second, it improves the chances the business can expand shareholders' fortunes rather than having to expend capital. The franchise product is a durable product with a competitive advantage that's sustainable over the long run, 5 to 10 years, in high demand by a large segment of the market, little or no close substitutes, little or no government regulation. The example used in the book is a good one. While Apple is a consistently high performer, they must stay ahead of the curve by investing in R&D, research and development, and coming out with new products that may replace major products already in the market. That doesn't mean that Apple won't be profitable in the future. It means that there will always be more uncertainty attached to their products. Graham always told us that speculation in the future was no way to invest. A steady Eddie like Coke already has a record for solid long-term success with its current franchise products. So, when considering a new investment, you should aim to determine whether change in technology will have a significant effect on the demand for the product in its future. This is what establishes a long-term competitive advantage. You must be able to ascertain the feasibility of a franchise product at least 10 years in the future. When Buffett says he doesn't understand a business, he knows how it works, but doesn't know how their future will look like. Again, it comes down to the simplicity of the business and investing story. Mr. Buffett says the chance of being very wrong about Coke, where he does own shares, is probably less than being very wrong about Apple or Google. Ultimately, he says, I just don't know how to value them. So here, I'm going to show you a breakdown of this. As you can see here, this is if you invest $50,000 in a 10% investment and hold for 20 years. So for example, let's say you invest $50,000 in an S&P 500 exchange traded fund from Vanguard or iShares and hold for 20 years. You're likely going to turn this investment into $336,375 if you don't sell. So that's if you don't sell, and then you'll pay $42,956 in taxes. So you don't pay taxes until you sell the investment. That's the benefit of investing. If you have the investment still in the company, you don't pay taxes until you sell. So that's the big benefit of investing. So that's why that's one of the reasons why investing is great, is because you only pay taxes once you sell the investment. You don't pay taxes while the investment's invested in. So this is if you didn't sell the investment anytime during this 20-year period. So that's the power of not selling in this case. It goes from 50,000 to 336,000. However, if you sell each year, your gain you'll go from 50,000 to 200,847. So you miss out on about $136,000. So that's if you sell each year. So you'll have to pay taxes after each year because you're selling after every year. So you'll pay taxes, and you'll pay more taxes in this case. So you pay 58,663 taxes instead of $42,956 in taxes. So yeah, if you don't sell each year and you just hold it for 20 years, you'll make $136,000 more, and you paid the less in taxes, $16,000 less. So it's beneficial to just that's why not selling after each year is very good. So the one caveat here I have is that if the company is falling apart, if you know that the company's operations are not what it was, if you know that the company's operations have changed for the worse, then sell. That's a good reason to sell. But if you think the company has stayed the same over the period and it's improved, it's become better, then that's a reason to keep it in the investment. So as you can see, you'd make in total, you make almost $100,000 more if you hold the investment instead of selling after every year. So, according to Buffett, what causes risk? Excessive debt. Buffett never considers a company that has a debt to total asset ratio greater than 30%. Overpaying for an investment. The price you pay for a stock